Hello, Oak Bloke here, and it's the first video I've done in a little while. Uh, Not intentional, I've just been busy, I guess, but the wait's been worth it, I'm sure. And this is going to cover IDHC, so this is Integrated Diagnostic Holding Company. So this is an idea that I first covered not so long ago, actually. August 27th was the date of the article, so here we are on the 8th of September, and the reason to cover this a second time in a fortnight, and I won't go back over this because there is a separate video that you can watch that covers this. But yeah, I suppose the key points, just to quickly sort of do a quick version on this. The key points here was that yes, it's Egyptian pounds, and yes, the Egyptian pound has declined in value over several years against the British pound. Its majority operations are in Egypt, so it's diagnostics, so it's all of the kind of things that you'd imagine people get diagnosed for. So it's covering off different sort of parasitology and different sort of health tests that they cover, and they've got operations across Jordan, Nigeria, Saudi Arabia, and the Sudan. And what I found was that even basically, if you just translate the numbers back into GBP, I mean, it sort of came out very favourably. If we take they've got radiology and pathology as the two different main activities, and yeah, if you take those, that even after allowing for the depreciation of the Egyptian pound, the business is pretty strong. The other thing I would comment upon is simply that, let's just bring this up on screen so we've got it to hand, is that the I mean, yes, the share price is down over the past 7 or 8 years, but actually, let's just bring this across. And obviously, it looks a bit scary when you look at, the cliff edge that it fell down, I guess you could call it. Obviously, there was a very big fall here with COVID, early 2020 COVID, and obviously that affected a lot of companies. It affected the NHS. So yes, there was a reduction in valuation. You can see it's kind of been fairly flat. If we zoom in here, we can sort of see it's hit lows of about 35 cents, US cents, 35 cents, and has now sort of returned back up to just under 50 cents, or it's at 50 cents this evening. It was at 48 this morning. And you can see here it's announced a dividend. It's an excuse me, announced a dividend as part of its 1H25. So this, as I say, I'm not going to go over the whole of this, but when you start to look at it from the point of view of the Big Mac meal index, so the fact that a 285 Egyptian pounds buys you a Big Mac meal delivered for £4.36, means that Big Macs are cheap in Egypt. And what I mean by that is that the cost of making and delivering a Big Mac is, the theory goes, and this is an economist concept, that whilst exchange rates might differ, when you take a typical good that you can buy across every country and compare the prices of that typical good, that's a good indicator. And they coined it the Big Mac index, because why don't you compare the cost of a Big Mac meal? So I have, and if you can buy that in the UK for £4.36, yeah, you've invented a time machine, because well, back when it cost £4.36, there was no such thing as a delivery service. You might be able to get a member of your family to go down to McDonald's for you, but that's the extent of it. Whereas today, that's the price in Egypt delivered. So by my reckoning, about 70% cheaper than what it would cost you in the UK by the time you pay the third party delivery fees and the tip and all the rest of the stuff that comes along with ordering a Big Mac meal. Not that I particularly do, but that's kind of that's the background to this. So this article that's going to be released to my Substack. So you're seeing it here first. My Substack being theoakbloke.substack.com. Put my teeth back in. This is called Impressive Growth. Do tell Sid Hook, and you'll kind of, if you're of a certain age, you'll remember this from the 1980s. Was that everyone was going around telling Sid, even though Sid didn't exist, it was just part of a marketing campaign. But the marketing campaign featured Cockneys, Yorkshire folk, rural types, milkmen, carrier pigeons. They were all at it. They were all telling Sid. So I suppose the point of this article is I'm the one telling you, so if amongst my many readers there's somebody in there called Sid, I've looked at my reader database and I can see there's one. So I'm telling Sid plus the 3,000 other people that subscribe to the Oak Bloke that, and this is the Tell Sid advert that I've stuck in there for a bit of fun. This British Gas advert. This was the privatisation of British Gas. So yeah, whilst some pundits call this share too complicated, and my last article was, is it too complicated? I've kind of come back and said, well, no, not really. It's you just translate it all into GBP, think about inflation, think about this, think about that, and do a valuation. I mean, yes, you've got to be happy that the Egyptian pound's not going to crash down further, but when Big Macs are costing £4 out there, and when they are reducing their national debt far faster than Britain, far faster, they're growing their economy far faster than Britain, and so on. That that's the economic growth for Egypt, and also that it's not all about Egypt. They've got growing operations in Saudi, Nigeria, Jordan, and so on. So they've, it's not just an Egyptian story, but could the British pound crash? I mean, I think there's potentially more chance of that than of the Egyptian pound crashing. So yeah, I don't accept that, that because it's a foreign operation, it's an operation based in Egypt, that it's therefore a societat non grata, as they would say in Latin, which is a company an uninvestable company. So as far as I'm concerned, that's complete garbage. Now, just to kind of shout out to the Wizard of Windsor, whose idea this was. So, thank you to him for suggesting it to me. He, just sort of call him out for his sharp eye to spot this in the first place. So I didn't run a screen. I didn't do anything particularly to find it. I am looking at different ideas, but this wasn't one that was on my radar particularly. And when I kind of first had it as an idea from him, I did sort of think, okay, that's going to be complicated. And, it's funny because, where you've got complication, there's quite often hidden value, because if it's too complicated for one person to look at, it's probably too complicated for all people to look at. So you've got that sort of idea of find opportunity amongst the complication, and hopefully I can make it less complicated for you, the viewer, the reader. Anyway, so as I say, the Q2 results came out, the first half results, which is why I've recorded and written another article. The exchange rate hasn't moved since Q1 to Q2, so that's good. They've announced the dividend, so 3.5% dividend yield, and that's just an interim dividend. So in other words, they might do another dividend at the year end in 6 months. Who knows? In the spring. So let's get into the numbers. So I wrote my original article, I had this graph. I had to steepen the angle of these blue lines being the trend line. I had to steepen the angle for 2Q25. Now, what I've done is that is the first quarter results times 4. That one is the combination of the first quarter and the second quarter times 2. Okay, that's what I mean by annualized. But you can see whoosh, this is the adjusted EBITDA up a lot. Net profit, yellow, up a lot. And revenue is this grey line here, up a lot. Okay, so up in Q2 25. Is the short version. If you want to not watch a long video and you just wanted to get the gist of it, that's it. The profits are rising spectacularly fast, and these are the numbers here. These are in Egyptian pounds to start with. So you can see, we've got a jump here to 1142. Now, bear in mind that this number here is, as I say, times 4. So obviously 1/4 of that is 245. So if you take 245 out of there, which basically means the second quarter is extremely strong. So if we see a similarly strong or stronger third quarter, fourth quarter, I mean, it's not to say that this is what I'm expecting as the outcome at the end of 2025. I think it's going to be stronger still because it's still growing. And there's things that they're putting in place to support that. So as you see, revenue up, EBITDA up, net profit up, patients up, and tests up. So when I say up, it's kind of back to where it was in 2024 in terms of number of tests. Patients slightly down compared to 2024, but the point being that the big difference, I mean, you can sort of see it here with the net profit and with the revenue. They've put their prices up. Inflation has gone up, the cost of doing stuff has gone up. Sorry guys, you're going to have to pay more. And because this is healthcare, and because these are tests that some of them are what's called walk-in tests. People will literally, the process is that people will go to their doctors. Now in the UK, when you go and see your GP, the GP will sort of scribble and write notes and say, "Oh, I'm referring you to a consultant or whoever." You then sort of wait and wait and wait. You go on a waiting list. That's what waiting is about. Or you go private, and you don't wait, you pay. In Egypt, there is no waiting list. There is no NHS. They just go straight to private. Okay, that's the way it works, is that the GP or the doctor will say, you should go and get a such and such test. The walk-in patient then just goes away and finds someone to do it. And one of the people that does it is IDHC. In fact, IDHC is one of the leading brands that does it. So that's kind of the walk-in patients, and they pay more. And then separately, you've got kind of like a Bupa and a sort of Bupa equivalent in Egypt, where trade unions, employers, the government, they'll basically have all of their staff as part of your salary package. You get an IDHC testing kind of package, so you can go to the doctor once a year and get yourself checked out for this, that, and the other, and tested for this, tested for that. And the rate, the price that those bodies get charged is far lower. Okay, so the walk-in patients pay more, the people that buy in bulk pay less. Kind of sensible stuff, really, isn't it? But the point being that let's get into the numbers. That and just before we do, actually, in profit terms, okay, the in 2019, when the share price was up here at $5 or $3.75, certainly well above $0.50. basically what we're saying is that the in Egyptian profit terms, okay, today IDHC is twice as profitable as back here when it was at $5 or $3.75, twice as profitable. But but, and this is the point that obviously, you know, critics will say, oh well, but what about the inflation rate, what about the value of that money, you know? And this is what I mean by funny money, is that obviously, you know, the rate, the value of Egyptian pounds in 2019 was very different to the value of Egyptian pounds in 2025. So what we need to do is we need to sort of deflate this back into 2019 real terms, okay? And that's what I do here is, if you actually consider that inflation has destroyed 3/4 of the value of the Egyptian pound in 6 years, so one Egyptian pound today is worth 25.5 pence in 2019 money. So what I've done is I've taken that double profit and I've rebased it to 2019 prices. So what we actually see is that net profit is only 58% of the profit back here, okay, but the share price is has dropped by far more than 58%. You know, there's a so the drop here is actually 42%, you know, but the share price has dropped by far more than 42%. So in other words, you make your own mind up on this, but you know, there's the numbers in 2019 terms, that even today, you know, they are making 60% of what they made back when the share price was kind of 10 times what it is today. The EBITDA similarly was, you know, it's down by a third. The revenue, it's down by less than, dropped by 18% in real terms. Okay, so what that tells us is that costs have gone up, which is true, of course. You know, everyone, all the costs go up, so the profit is not quite where it was, but the revenue is growing. You know, so this is the bit that they've been working on. This is the bit they've been working on, is to restore profitability. Okay. But I thought that was very interesting. So, you know, if you pro-rated that share price there, 375, I mean, you would get to 217. I'm not saying that should be or is the target price, but obviously for about 4 years, you know, the share price was at or above 375. So, you know, at this point here, people kind of valued the company that way. Pro rata, if what they were doing back here to value it still applies today, then pro rata, the share price should be quadruple what it is today. Okay, that's kind of looking at it, just deflating it by the cost of money. So that was interesting. And if you turn it into GBP, because obviously the yardstick that I'm measuring there is Egyptian pounds from 6 years ago versus Egyptian pounds today, and I'm deflating it by inflation. Well, if we instead say, well, whatever the FX rate was back in 2019 versus the FX rate today, you know, like turning it back into pounds. Now, obviously, you could do the same, couldn't you? You could say, well, you know, the value of my pounds in 2025 is less than the value of my pounds back in 2019. So you could do the same deflator, I suppose. I haven't done that in this article, but you know, in terms of how much it's lost, it's as of 2Q25, it's lost 21%. So back here, net profit was 21.7 million pounds a year. Here, and again, this is an annualized number, just to be clear, annualized number. The net profit, what I mean by annualized number is the underlying profit is 8.5 or 8.57, and I've doubled it. Okay, I've doubled it. So, you know, if anything, it will be higher because the first quarter profit was smaller because of Ramadan. Okay, so third quarter, fourth quarter should be potentially higher than that number there. In other words, we might even get to 21 million by year end. Okay, you know, I make the point here, it's the weakest of the 4 quarters. You know, you know, if they carry on growing at the rate that they've been growing at so far this year and last year, then I could see this, you know, so net profit in the first quarter was 7.3, second quarter was 9.8. So you can sort of see, there's that doubling of profit. It's only 20% less valuable. Now, the next thing I'm going to talk about is GDP and spending by country, because I thought that was an interesting thing to get. So this I think is very interesting, that back in 2019, healthcare spending per person was, and this is in US dollar terms. So once again, you've got to obviously potentially deflate it for the value of the US dollar then and now, which, again, you've got to sort of take that into consideration. But in real terms, there has nevertheless been a 20% increase in nominal terms. These are the latest numbers, 2022. There's not newer numbers than those, but Egypt is now spending 20% more on health, now being the latest numbers, versus back in 2019. Jordan, slightly less. Saudi Arabia, slightly less, but these numbers are not hugely different. Nigeria is spending substantially more, and Sudan, basically that has collapsed into anarchy and civil war. So they are spending 122 per person on healthcare, which presumably is patching up gunshot wounds and machete wounds and all sorts of horror, probably that's pretty awful. But that's kind of what's going on in Sudan. So Egyptian GDP growth is strong. This is just something I've lifted from the prior article, but just to reiterate that point, that this year they're looking at 3.8% growth. This is just forecast numbers based on, I think it's World Bank numbers, but you can see, growth strengthening through the next 5 years. So the Egyptian economy by 2030, if it's growing at that rate, is going to be about 50% above today's level. Yeah, so that compounded. So think what that does to that number there. That the healthcare spending will proportionately rise as incomes rise, because as people get richer, they spend more on health. That's just a fact, and that's a fact that you can sort of see here, with these growth numbers here, that it's increasing, whereas this, GDP has collapsed, as I say, and that's caused a 40% reduction. With these, I suppose Saudi Arabia is more of a, the GDP growth isn't as strong there. That it's and Jordan, to be fair, I don't know what the GDP numbers look like there either. But yeah, I'd say there's a strong argument to say Nigeria and Egypt will continue to grow in terms of how much they're spending on health. Increased profit. So this I thought was very interesting. So this is taken from their results. Pathology revenue up 45% year on year. So this is the first half last year, first half this year. This is in Egyptian pounds. 45%. Radiology 18%. Jordan 7%, in Jordan currency terms, but 28% in Egyptian translated terms. Nigeria 38% in local currency, 49% growth in Egyptian terms. Saudi Arabia 459%, obviously from a very small start, 4 million to 25 million. So it's a flea on the back of the camel, but I'm going to talk about Saudi Arabia in a moment. So you can see increased profit driven by lots of cost control, stock optimization, better buying of test kits, better purchasing, getting discounts, just optimizing headcount, reducing back headcount where they need to. I've sort of said optimizing headcount's a euphemism for firing people, making people redundant. That's the way that you get more efficient, is that you just right size the number of people for the number of patients, for the number of tests that need to be done. Improving the cost of goods sold, cost of wages, cost of salaries. Nigeria became a bit to positive, and we'll talk about Nigeria in a moment as well. And just the whole concept of doing what's called hub and spoke. So the idea is that you don't put all your test equipment and kit out every single branch with the same equipment. You basically have a central place, a central hub that has, let's say, an MRI machine, and then all the sort of clinics, all of the local branches will send the results or the processing into that, and they try and economize on the equipment and on the kit. So just sort of take advantage of the economies of scale. So you can see here they've made a really big improvement here year on year. So cost of goods sold went from 63% of revenue to 58% of revenue. So that's a massive jump. And you can see here raw material costs down, wages and salaries down a little bit, depreciation down, so they're making better use of equipment, in other words, and other expenses as like cleaning and incidental, so that's down as well. So really good result there, really encouraging, really solid. And that 42, I mean, that's a 42% margin, folks, 42% gross margin. That is impressive. And I kind of talk about this a bit more in a moment. In fact, when you actually analyze these, I mean, wages and salaries is going to be, I mean, it's pretty much a fixed cost because you'll just staff these branches and then, people come along and, like that is pretty much a fixed cost. Depreciation, you put equipment in there, that's a fixed cost. Yeah. The stuff that definitely is a variable cost is the raw materials. The more tests you do, the more materials you use. So that's a variable cost. And other expenses is going to be a mixture, but probably quite a lot of variable cost. So in other words, in terms of variable cost, you're looking at something like an 80% margin, or maybe 70%, 68% margin, when you take those two parts of it out. This is kind of a fixed cost. So, as they grow this, the profits are going to be substantial just because of the margin that these are on. I mean, that is just like, that's worth looking at very closely and thinking about. And I'll tell you where the proof, what made me think about this, was it was Nigeria, no, sorry, Saudi Arabia, and we'll talk about Saudi Arabia in a minute. But just before we do, I'm going to talk about gross profit per patient, because again, this is very impressive. So the bit that's very impressive is the contracted patients, so the trade unions, the big employers, the government. So basically, they hit record levels of 2.14 for the quarter, 2.14 million for the quarter. Annualized, that's 8.5 million patients. That's nearly double the number of patients back in 2019. Just to give you an idea, we were talking about 20% less revenue in GBP terms. Sorry, 20%. Sorry, start again. 20% less profit in GBP terms. 42% less profit in deflated Egyptian 2019 currency terms. But in terms of number of people that they are pushing through their business, double. That's impressive. That's not a declining business. That's not a struggling business. That is a business that is growing. And what they need to do, obviously, is right size the pricing. They need to charge for the services. People need to pay the going rate. I mean, when you've got things like scans and healthcare, I mean, it's critical, isn't it? It's a defensive idea, really, because what choice do you have if you need to get a diagnosis for whatever disease you think you may have? Obviously you could shop around and try different clinics or whatever, but these guys use sort of modern equipment. They're working with GE and Siemens and all of the sort of big brands, Hitachi Health, and so do you go to the backdoor guy that's got something from the 1950s for your critical diagnosis, or do you go to the clinic that's got the 2020 equipment, 2020s equipment, brand new, slick, efficient, good reputation? I think that again, it's one of these things where in a privatized health market, like, you wouldn't scrimp on stuff like that. You would just pay the going price, I think. So what I'm trying to say is there's quite a lot of pricing power, in my opinion. And that's been evidenced by prices have gone up, but the demand hasn't gone down. It's inelastic, okay? And that is a very, very strong, powerful thing to have. And that's kind of partly why these percentages are down, is because the revenue, this is a proportion of revenue, but if you're charging higher prices, then the proportion of cost of goods goes down. So it's not just the fact that they've reduced cost of goods in absolute terms, it's in relative terms where that's important. But yeah, 8.5 million patients annualized despite putting up the prices. So the only bit that I was worried about, not overly worried, but is noticeable, was this number here. Walk-in patients for the quarter, only 240,000. So on the investor call, if there's an opportunity to ask, like, what would be your comment on the drop of, because remember, this is the Ramadan number here, 0.6 of a million, and they've now got walk-ins of less than half that. So have they put their prices up too high? Don't know. That's the one I'm keeping an eye on. But this 2.14, 8.5 million patients. So you can see here, back in 2024, it was 5.8 million. The year before, it was 4.8. And 2019, it was 4.8. So 8.5. Well, it's not quite double, but it's getting on for sort of about 70% higher than this number here. So I say nearly double. Well, 8.5, double of 4.8 would be 9.7. So it's sort of a million away from being double. So I don't know if that qualifies for nearly, but you get the idea. So that's the only disappointment, is that number there. But this number is spectacular. Look, double, pretty doing it again, aren't I? Nearly double, this number. And again, that number would be 8.5, versus sort of 6 million there in the prior year. Over here, the contract. So it's not a vast jump, but the jump from 284 gross profit to 339. So the gross profit total has doubled, genuinely doubled here from here to here. This has obviously dropped, but this has sort of more than offset it. Okay, and obviously the split's pretty much the same. Which so that's kind of my analysis of the contract walk. And they didn't give all the same disclosures in the second quarter update. So yeah, I did have to sort of fiddle around with the numbers to get them to add up and things like that. You can see that's why I did these subtotals here, just to kind of sanity check that I'd not lost a million patients somewhere or something like that. Anyway, moving to Saudi Arabia. So Saudi Arabia lost money last year. So this is a growth market for them. They see it as an important driver of future growth due to their large, growing, and increasingly health conscious population, which is looking for access to high quality diagnostic services from into a currently highly fragmented market. So they want the one-stop shop. They want to have sort of the ability to do different tests. And when you see the numbers, that's not an exaggeration. So losses halved while growth was rapid. What I found profoundly interesting was the dynamics for future profit. Let me explain what I mean. Saudi Arabia should, on the basis that if it's up and running at the same kind of pace as an Egyptian clinic, they should be able to make the same margin, at least the same margin as an Egyptian clinic. That, I think that's quite fair. So therefore, and especially as the revenue per test for Saudi Arabia is 439 versus the average in Egypt is 165. And then it's 20% higher in Saudi Arabia than the walk-in patient. So the 365 per test, compared to 439 in Saudi Arabia. So in other words, IDHC are charging much higher prices in Saudi Arabia, is the first thing to say. So really the gross margin shouldn't be 43%. It should probably be more like 55 because they're charging such higher prices. Yeah. So the problem therefore is just scale. How many people are they getting through the doors? And what I did to kind of work this out, it was basically I took the so this is the result. So the last year first half they lost 6.1. This year first half they lost 2.7 EBITDA. Obviously, the net profit's lower still. But when you analyze out the numbers, it was very interesting. They did 7,000 tests that grew to 57,000. So obviously, 6 times increase there. Patients went from 1 to 11. The revenue per patient in this, and I sort of thought, well, this is just like a huge number here, 4,000 Egyptian pounds per patient. I thought, wow, that's a really high number. The revenue per test was 571. Well, that suggests that each patient, if the patient is 4,000 and that's 571, well, they were having like 8 tests per person. And I was like, well, that's double what the Egyptians are having. Like the Saudis are like, yeah, test me for everything. Yeah, here's my wallet, here's my credit card. Just test me for everything. Like the Egyptians, like, oh, I'll have a 4th test. Oh, and maybe I'll have a 5th test. The Saudis are like, oh no, 8 tests, 9 tests. So very different numbers. Very different numbers. That 4,000 Egyptian pounds, that compares to now this is the gross profit per patient. So obviously that's but that, I think it was from memory, it was about 1,000 for a walk-in patient, or maybe 1,100. So comparatively, the Saudis are spending like, well, double or triple, depending on and I think this probably is a bit of an erroneous number, but we see it sort of settle down a little bit here, like 5.5 tests in 2025. So but what I took was the patients per branch, because last year it was 1,000 patients per branch, so that many tests, that many branches, so to kind of get to that, sorry, that number there, that number there, that number there, that number there, 3,600. Just to kind of give you an idea, Egypt, overall average for Egypt is double, nearly double, 6,289 patients per branch. So in other words, this has got to grow to sort of probably that average or higher, for them to be at capacity. So what I did was I worked out the difference of the EBITDA. So basically, I sort of took the 20% variable costs. I sort of took the other expenses. So I sort of said 60% of cost of goods sold is variable, 40% is fixed. So for them to have made this difference of profit, I worked it out to kind of if you work out the variable costs must have therefore been 5.4 million Egyptian. The fixed costs must have been 22.7 in order to lose that quantity of money. So to lose an overall 2.7, the fixed costs must have looked like that, because the revenue was 25. Okay, so that number plus that number, compared to the 25 million of revenue, is 2.7 loss. So I was like, okay, great. Well, if I know that the fixed costs is 22, so I've sort of done the mathematics there. Look, so that loss before interest, tax, depreciation, amortization, 2.7, is based upon cost of goods being that number, revenue being that number. We've lost that amount of money there. So I sort of said, right, okay, well, that 25 million, for a start, they're charging at least 20% more. So the underlying revenue, like the Egyptian equivalent revenue, would be 20 million. Cost of goods would be 60% on that. So that's that number, so that's kind of how I arrived there anyway, just to kind of work out the break even and so on. So what I did was I said, well, okay, let's get that number there to that number there. Okay, so they've now got the average of the Egyptian branches. Okay, the revenue's the same, the number of tests is the same, but in order to get that number of and as well, they are looking to sort of increase the branches. So some of these, these branches are coming online. So there's kind of on the basis that they're going to be working with 6 branches in the future. They're looking to increase this. Basically, all of these numbers at that number of patients works out at 38,000 patients, 196,000 tests, generating that much revenue, generating that EBITDA. And I'm basically taking the fixed cost, the 22, to work out that EBITDA number. Anyway, kind of the long story short is that 45 million EGP profit, and that's per half year, so that's 90 million Egyptian a year per year. It boosts the overall profit of the business by about 5%. Once their 6 branches are up and running, doing their thing, getting the the 2,002, and I'm assuming it's going to be 2,200, not 4,000. If it is 4,000, it's going to increase net profits by over 10%. So just kind of so it's an appreciable increase, and that's just based on 6 branches. If they go above that to more, then then so in other words, 6 branches compared to 636 is kind of, well, it's less than 1% really. 1% of branches are going to generate 5% increase of profit. That's pretty good, and that's because they're charging higher prices. People are having more tests, and the profitability is there. I mean, it's not an exact science of where I'm getting that number from, but that's kind of my best guesstimate of what Saudi Arabia could look like in the future. Net profit per patient, all countries. I thought this was interesting. So what we see this is now in GBP terms. That in GBP terms, so 272 revenue per test is sort of more or less the same as the first quarter, slightly down, but obviously up from last year. We can see net profit per test. So this is the revenue per test is down slightly. Net profit per test is up, okay, by a few percent. Revenue per patient about the same, and then net profit per patient up. And that's sort of net profit per patient up is largely down to that increase of pricing to the contract patients. Okay, that was my analysis. So growing radiology, the next part. So they've got their existing pathology business. The radiology business is actually quite new. The radiology business is made up of, there's an operation in Egypt, there's an operation in Nigeria. The Nigerian operation, reading between the lines, we've upgraded equipment, we've done this, we've done that. The Nigerian operation kind of needed quite a refresh, new equipment, upgrades, and refreshes to kind of get it fit and in shape. They do like MRIs, CT scans, X-rays, mammograms, cath lab. So that's kind of the radiology business, and it's a much newer business than the pathology business. They achieved 45% growth last year. In the first half of this year, they've so far achieved a further 18% growth. They've expanded their number of branches. So they've basically bought. They've invested 130 million Egyptian, which means that they've spent 600 million Egyptian on radiology. They've acquired an 8th location in Cairo. This was at the end of the period, so there's no real sort of numbers in. So they spent 400 million. So obviously 600 plus 400. That's now a billion Egyptian. Which, if you divide that by 67, then that's kind of a fair chunk of change that they're spent. So that part of the business, now this was where I was a little bit surprised, that part of the business, the radiology business, only generated 6.6 million EBITDA profit in 2024. The point is it's growing fast, and I think the other point is that whilst with the pathology that you'll have, sort of tests and raw materials, with CT scans and X-rays and mammograms, I mean, you get the sort of cost of the paper, the X-ray photograph, but the variable costs are probably a lot lower. It's probably the case that it's all about kind of sweating your fixed assets and getting the numbers of people up. So, whilst the profitability is not great at the moment, I kind of saw this as sort of, they sort of speak of exciting opportunity but the reality, folks, is that the EBITDA per patient, that 6.6 million, works out to a shocking, I think, shocking 11.5 pence in British money, 11.5 pence per patient profit. I mean, you kind of think, wow, is that even worth doing? But as I say, the only thing I can think here is that it's it's all about the long term. That the profit margin at the moment is low because they're having to cover a lot of fixed costs, because they talk of vast potential, that it is earlier stage. So, if they can repeat performance or better of pathology, then it's a rinse and repeat, and also a cross-sell upsell, for the same people that are having their pathology tests. And also just the macro, where you've got, even though there's there's a high birth rate in Egypt, there's also a lot of elderly people, a lot of people living longer. The average life expectancy has risen, and therefore there's more need for these services than ever there was before. The incidence of cancer and different things like that. So so I sort of leave it as an open question a little bit around the uh, the variable costs element, and whether we'll just see a, a, a much increase, because you imagine if revenue is increasing 18% per half year, and if the fixed costs are being covered with sort of 11p per patient profit, the 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 increase of profit is going to be ratcheted up because those fixed costs are being covered. As part of this as well, I mean, if we look at comparing, the radiology in 2024 versus 2025, this is just, and I haven't annualized these numbers, just to be clear. We can see that this is growing. We can see, there's not, because they don't report things the same way in the half year. I'm sort of left with a slight question mark over. All we know is the revenue is up comparatively, and obviously that number there includes Ramadan, of course. And then this is the Egyptian operation. Nigeria operation, on the other hand, we see a much stronger performance. So essentially what they've done is put their prices up because the number of branches hasn't changed, the number of tests hasn't really changed. That number double is the same as last year's number for the full year. So that's the half year number, that's the full year number. Number of patients hasn't changed. What's changed here, I mean, if you double that number, you get to 116 versus 82. They've put their prices up by nearly 50%. So they've turned around what was a loss-making business into an EBITDA profitable business, and EBITDA profit per patient was 2.6 Egyptian pounds. So I mean, that's even less than the 11.5p, but at least there's an EBITDA profit. It's heading in the right direction. So that's the balance sheet. Just quickly talk about this. I mean, I've turned it all into British pounds over here. Okay, so this is British pounds over on the right hand side. What we see is essentially the balance sheet moves from, so shareholders' equity grows period to period by about 1.5 million. We see basically, and I've simplified the balance sheet, because what we see here is we've got about 20 million of equipment, 28 million of intangibles, leases. That's our non-current assets, 60 million, stock debtors. There's a lot of cash on the balance sheet, money market investments. This is an investment in one of its clinics. Then we've got some provisions and deferred tax. But I've actually simplified the balance sheet down here. So kind of when you look at it simplified, and what I've done is I've stripped out like offset the borrowings against the cash, for example. So net cash is net of borrowings, and I've stripped out the leases. So the net leases is basically stripping out the asset of the right of use asset, just so I can sort of see, clearly what the net liability is. So you can kind of see, the simplified balance sheet takes you down to 87 million equity and liabilities versus 114 on the full balance sheet, because there's just entries like here, for example, this minority interest minus 11 million is a claim on these equipment and assets up here of 21.5 million. So what I've done is I've just netted the two off against one another to say, well, net plant and equipment is 10.5. But what you see here is that you've got like 48 million of current assets net of liabilities, and then maybe like 12 million of creditors, and then things like deferred tax and tax liability. I mean, maybe sort of that is covered by just cash, and then you've got stock and debtors. You've got sort of 30 million of current assets and 10 million of equipment. So you've got sort of a strong balance sheet, essentially, is what I'm hopefully trying to show you there, is that when you strip out all the things that would be claims on the business, creditors being a claim, debtors and borrowing being a claim, and tax liability being a claim on the business. Once you strip all of those out against the assets of the business, the assets that you could liquidate, because obviously cash and money market that you could liquidate, debtors will turn into cash, stock will turn into cash, will turn into debtors, turn into cash. So you kind of, you're well covered, or the business is well covered. So anyway, just to conclude, net profit on the face of it is up 19%. And then because Egyptian inflation's 14%, that you could sort of say, oh, well, net profit's up 5% then in real terms, big deal. But the interesting, and that's what we're seeing here, up 19%. So this is sort of the statutory profit period to period, which obviously 19%'s good, 5%'s okay. It's net of inflation, 5%. If you actually took some British businesses and stripped out inflation from their numbers, you would not get to 5%. So 5%'s okay. I think what's very interesting though is how about 214%. So actually, if you take out foreign exchange gains and losses, because here there was a massive foreign exchange gain, and here there was a foreign exchange loss. So actually, the underlying business performance, okay, from the first half of last year to the first half of this year, basically is a difference of, so it changed from 183 million last year to 575 million Egyptian this year. So, a 214% increase in net profit, which, taking into account inflation, is still triple digits. It's massive. I mean, like that alone, when you actually sort of catch your eye with that and go, hang on a minute, what? And just to kind of give you an idea, I mean, obviously 575 million Egyptian kind of doesn't mean very much, but if we sort of turn that into British money, so they've kind of got 8.6 million, and that's where I'm getting the 17 annualized, 17 million annualized profit from, underlying profit from, is that I'm taking that number and doubling it. But I mean, that is just a phenomenal result, compared to 183. So same thing again. So the profit has gone, the underlying profit has gone from 2.7 million net profit in British pounds to 8.6. Yeah. And this is a share that you can buy for 205 million pounds today. So just go into there. $280 million is 205 million sterling. So, if we take the valuation and divide that by 2 times 8.6, which would be 17.25, I think, it's on 11.8, 11.9 times earnings, 11.9. Which for a business that is growing its profits by 200%, I mean, well, I mean, if they can repeat that performance in 2025 and repeat that performance in 2026, that price earnings will not even be well. I mean, if they can double the profit and double the profit, that will be like point 0.3 of for every pound you've got invested, it will be generating £3 of profit if it can double and double the way it's done in 2024. Sorry, in 20, sorry, first half 24 to first half 25. So this last bit here is just, I mean, that's the bit where you fall off your seat because that is massive. So anyway, underlying net profit, yeah. So 214% increase. Don't forget to tell Sid is kind of how I conclude the article. So as I say, this will be released on Substack. So I hope that's been useful. Obviously, quite you could say it's complicated, but equally, like just put the exchange rate in, put the inflation rate in, deflate the numbers. It's not that hard. Well, I don't think so. Anyway, hope that's been useful. That's all from the Oak Bloke. Signing off. Cheerio for now. Cheerio.